For decades, something huge has been building across Africa's economic landscape. But we're not just talking about new roads or bridges. This is a fundamental rewiring of how the entire continent connects to the global economy. And we're going to start with a really simple example that, believe it or not, reveals everything.
Okay, to really get this shift, let's start with something you do every day: sending an email. Imagine you're sending a message from Lagos, Nigeria's bustling economic hub, to Accra, the capital of neighboring Ghana. That's a pretty short hop across West Africa, right? You'd think it would be a straight shot.
Well, for years, you'd be wrong. That little email didn't take the direct route. Instead, it would travel thousands and thousands of kilometers north to an exchange in London or Marseille just to be beamed all the way back down. I mean, talk about inefficient. It was slow, it was expensive, and it was a perfect symbol of being dependent on outside infrastructure.
But that entire dynamic, it's now being completely turned on its head. So that brings us to the big question. Why now? What on earth is driving this sudden, and I mean urgent push for digital and economic independence across the continent?
Well, the first part of the answer is a massive infrastructure race. But hold on, we're not talking about pavement and concrete here. We're talking about fiber optics and data centers. Tech giants, the big ones like Microsoft and Amazon, are pouring billions of dollars into getting a real physical foothold in the African market.
To get a sense of just how big this boom is, you first have to understand the gap they're trying to fill. Get this, right now the entire African continent has about the same amount of data center capacity as the Netherlands. Just let that sink in for a second. With a population that's set to nearly double by 2050, the potential demand is just astronomical.
So there are two key forces driving all this investment. The first one is latency. We all hate it. That annoying delay before a video starts. If you want to tap into Africa's super young, digital-first population, your services have got to be lightning fast. Storing data for Netflix, for banking apps, for cloud services locally means no buffering and a way better user experience.
The second driver is a bit more political, and it's called data sovereignty. Basically, governments across the continent are passing new laws saying, hey, our citizens' sensitive data, we're talking financial records, health info, it has to be stored within our borders. So if a tech giant wants to operate in these markets, they have no choice. They've got to build their servers right there in those countries. So you see, this is so much bigger than just getting faster streaming. This is about Africa shifting from being a passive consumer of the global internet to a region that actually hosts it. It really is the digital equivalent of building your own shipping ports instead of relying on someone else's.
And this whole theme of taking control, it doesn't stop in the digital world. It extends right into the physical one, specifically to all the valuable raw materials that lie just beneath the ground. For more than a century, the economic model for Africa's incredible natural resources has been brutally simple, and not in a good way. The playbook was dig raw materials out of the ground, ship them unprocessed to places like Europe or China, and then buy back the finished products, like batteries or smartphones, at a massive markup.
This chart shows you exactly why that old model is getting tossed out. The real money isn't in the raw ore itself, it's in the processing, what economists call the value add. Taking that raw lithium and turning it into battery-grade material, that multiplies its value like crazy. And now, African governments are demanding a piece of that action.
And this isn't just talk, we're seeing real action. Zimbabwe, which has huge lithium reserves, just banned the export of unprocessed ore. The DRC is looking at doing the same for cobalt, and Namibia is right there with them. The goal is crystal clear: force companies to build the refineries and factories locally, creating jobs and capturing a much bigger slice of the profit pie.
But this creates a huge risk. It's been called a high-stakes game of chicken. You see, these countries need foreign investment to build those processing plants, but the investors, they're getting nervous about unstable policies and infrastructure gaps. It's a really bold gamble to try and force industrialization.
And that kind of gamble, that kind of bold economic shift, creates immense volatility. Our third story highlights this perfectly, taking us to Africa's largest economy, Nigeria, and its currency, the Naira.
So in mid-2023, Nigeria's new government made a massive change. It decided to float the Naira, basically letting market forces decide its value. The result? A jaw-dropping devaluation. It went from around 460 Naira to the US dollar to over 1,600 in just a few months.
Now, the long-term goal was a necessary reform, but the short-term pain has been severe, especially for multinational companies. Giants like MTN, Unilever, and Airtel, Companies that earn money in Naira but have costs in dollars reported absolutely staggering foreign exchange losses. It effectively wiped out their profits almost overnight.
So we've got data centers, lithium ore, and currency shocks. What do these three totally different stories actually have in common? Well, it turns out they are all chapters in a brand new economic playbook being written across the continent.
When you really boil it down, you can see the core parts of this new playbook. First, demand control over your digital economy. Second, insist that the true value of your natural resources is captured locally. And third, rip off the Band-Aid on difficult but totally necessary market reforms, like getting rid of currency controls.
What we're witnessing here isn't random chaos. It's difficult, it's messy, and it's often a really volatile period of maturation. These are the growing pains of markets that are demanding more control over their own economic destiny, even if the immediate consequences are tough.
And that leaves all of us with the central question. Whether we're talking about data or minerals or currency, is this period of intense, short-term volatility simply the unavoidable price that has to be paid for greater long-term economic sovereignty and control?